Hello, Ed Parrott here with your latest real estate market report. At last, we got a little bit of good news. We have good numbers from both the inflation report and the jobs report. And also, mortgage interest rates are beginning to moderate a little bit. These two factors taken together are good news for buyers because they increase both availability and affordability for homes. Home prices are continuing to rise, but more slowly. We've got the October report from both CoreLogic and Black Knight, and they each show a 0.2% month-over-month increase from September. And respectively, they're showing a 4.7% and a 4.6% year-over-year increase. We don't have the reports out for Case-Shiller and the Federal Housing Finance Authority for October, but their latest reports show a 3.9% and a 6.1% year-over-year increase respectively. Now, we've got different indexes here, and they're showing different numbers, so why is that, and which one do we trust? Well, the two best indexes, in my opinion, are Case-Shiller and the FHFA. Now, even those two vary widely, and the reason for that is their method that they use to calculate the increases. Both of these indexes use transaction pairs where they look at the sale of the same house in 2 different years and calculate the rate of growth of prices from that. So the difference is that the FHFA looks only at conventional mortgages, so they leave out cash sales and also jumbo mortgages, whereas Case-Shiller looks at all transactions, and therefore, in my opinion, it is certainly the most accurate index to follow. Now, I did mention an improving situation in the jobs market as far as the Fed is concerned. What the Fed is wanting to see is a loosening of the job market, meaning right now it's considered a relatively tight job market in that it's sometimes difficult for employers to find people to fill the jobs. So that tends to drive up wages, which tends to drive up inflation, and that is something the Fed does not want to see. Now, we all know the government likes their acronyms, and they just put out the JOLTS report, which stands for Job Opening and Labor Termination. And if we look at that, we'll see that the numbers for October show that there were 8.73 million jobs that were available, and that's dropped down from 9.35 million in September. Now, that number is well below the 9.4 million job openings that most analysts were expecting, and it's also the lowest since March of 2021. But let's take a look at the report from ADP, which shows the number of jobs added in private business. For November, we'll see that there were 103,000 jobs added, and that brings the 3-month moving average down to 99,000 per month, which is also the lowest since March of 2021. While total job growth remains positive, there are sectors that have lost jobs. Those include leisure and hospitality, manufacturing, professional and business services, and construction. So while leisure and hospitality has been the strongest area of job growth over the last 18 months, this pullback would indicate that the job market is in fact becoming a little weaker, which is what the Fed wants to see. Now, while wage growth remains positive as well, it also is slowing down. For those workers that remained in the same job, they saw a 5.6% increase in their wages year over year, and those people that were promoted or left for a new company saw an 8.3% increase in their wages year over year. So still not bad numbers, but slower than they were. We will want to pay attention on Friday when the Bureau of Labor Statistics releases their jobs report, but both the JOLTS report and the ADP report indicate a weakening of the job market, and as far as the Fed is concerned, that's a good thing, because the Fed is looking at both inflation and employment levels. While nobody wants to see people losing their job, we do need just slow, steady growth in jobs, in my opinion, that would maintain the unemployment rate where it's at. We don't need a really hot job market, or a tight job market is actually the way I should word it, because that would put inflationary pressure out there again, And that is certainly the last thing we want to see. As I record this, it's December the 12th, and the Federal Open Markets Committee is having their meeting today and tomorrow. They'll be releasing their target rate tomorrow. Currently, the range for that is between 5.25% and 5.0%. And almost nobody, and I mean nobody, expects the Fed is going to increase the target rate tomorrow. But by the same token, nobody really expects they're going to decrease it either. Let's just take a quick look at these two charts from the Chicago Mercantile Exchange. These were published in October, and the first one shows the CME's prediction for this meeting here in December. And as you can see, they are predicting a 100% chance that the Fed will maintain the target rate where it is at. The second chart is their prediction for the December 2024 meeting. And as you can see, the CME predicts a 26.3% chance that the Fed will cut the rate by 75 basis points. And there's a 29.5% chance that they will cut the rate by 100 basis points. And if you want to go back to one of my previous reports a couple of weeks ago, I talked about all the charts for the entire coming year. And you will see that the further into next year we get, the more strongly the prediction is that the Fed will be cutting rates, and also the deeper they will be cutting rates. So the folks at the CME have both a lot bigger computer and a lot bigger brain than I got, so I'm going to rely on their numbers. Now, I've been talking about inventory and prices, so let's take a look. Even though the interest rates have jumped from 3% at the beginning of 2022 to hit a high of 8.03% on October the 19th before starting a slow drift downward, prices have continued to rise. Now, why is this? Well, it's a simple matter of supply and demand. Previously, the Fed had their target rate so low that mortgage rates were at historically low levels. So this means a lot of people got really good rates on their mortgage loans, and either people that were buying homes for the first time or refinancing their existing mortgage, they're sitting at a very low interest rate, and therefore they don't want to sell. The commonly used phrase is they're feeling locked in by their interest rate, because if they sell, then they're going to have to buy a new home and finance the new home at a much higher interest rate. Now let's take a look at this chart here, and you'll see exactly what I mean. Of the existing mortgages, 23.5% of them are at 3% or less. 62% are 4% or less. 82.4% are 5% or less. And 91.8% are less than 6% interest rate on their mortgages. So you can see why people, quote, feel locked in and don't want to sell. And that's exactly why inventory level has shrunk so low. And even though interest rates have gone up, really even 8% historically is not that high. You know, a more reasonable historical rate would be around 5 to 6%, although we all remember, well, I don't guess we all remember because we're all not as old as I am. I remember Jimmy Carter and 17% interest rates, but 6% or so is historically a good rate. However, if you got a 3% rate, then 6% is double. So they don't want to sell. But it's not so high that there aren't still buyers out there. So demand has definitely outstripped supply, and that has driven up prices tremendously. And just a little side note on the Fed here, I don't understand Jerome Powell's thinking at all. I mean, him and the other hawks on the committee like Kashkari and Cook, and there's a couple more I'm not thinking of right now. But my point being, they have raised interest rates so high and caused this price increase on homes. Well, homes go up in price, rent goes up, and shelter cost is what it's referred to in the inflation report. Shelter cost is a large component of the CPI. So they're basically trying to lower the inflation, but by raising shelter costs, that is the cost of houses and the cost of rent, they're actually increasing inflation. So maybe they're smarter than I am, but it sure don't make any sense to me. But I think we might be starting to see a little bit of relief on the inventory side. As we've mentioned, the rates are starting to drift down. and they're approaching 7% now. And if they keep on going down toward the 6% mark, I think you'll see a significant supply come onto the market, because there is a pent-up demand for sellers as well. As I've discussed in previous report, life keeps happening, and life is why people move on from one house to another. So if we look at the actual inventory level for November, it's increased 2.4% nationwide, bringing the total number of homes on the market to 775,000. This is notable because normally at this time of year, inventory is actually going down. Also of interest, new home listings for this November were higher than they were last year. And in fact, of the 100 largest metro areas in the country, 69 of them saw a month-over-month increase in inventory, and 43 of them saw a year-over-year increase in inventory. So since I'm based in Knoxville, let's just take a little quick look at the Knoxville market. Now, if you look on this chart, you'll see that at the end of November, Knoxville had 4,543 homes for sale and an absorption rate of 2.91 months. Now, what that absorption rate means is that's the amount of time it would take to sell out the entire inventory at the current rate of sales if nothing new was listed. Now also we see in November we had 1,827 new listings and we sold 1,367 listings. Also going along with the absorption rate, we'll see that the days on market has increased from a low of 29.9 to its current number of 36.2. Now last year we saw that Knoxville had 4,391 homes for sale at the end of November, and the absorption rate was only 2.29 months. New listings last year were 1,626, and sold listings last year were 1,483. So it is interesting to note that we have more new listings this year, but we've actually sold fewer listings than we did last year. Days on market last year, by the way, were 31.2, up from a low of 14.7 in July. Now this increase in inventory levels, both here in Knoxville and nationwide, should put some downward pressure on prices if the demand doesn't go up along with the increase in inventory. So we'll just have to wait and see what happens on that. Now, a lot of people are predicting that this downward pressure is going to be pretty severe, and we see all kinds of people out there screaming about the sky is falling. I've seen different things quoted: we're not going to make it through 2024. It's going to be worse than the Great Depression. It's just crazy what people are predicting. Now, I will not be at all surprised if we see a decrease in home prices this coming year, and it may even be as much as 10%. Most of the industry analysts that I've taken a look at are looking around 2 to 4% decrease in prices in 2024. So we'll just hang on and see where it goes. But in the long run, prices will continue to go up. My hope is that if they go down a little bit, they start going back up slowly. And I would like to see them go up very slowly for the next 2 or 3 or even 4 years, so that inflation as a whole can catch up with where home inflation has gone. Because let's face it, the prices of houses has way outstripped the regular inflation. But as I say, there's no need to panic, because even if you look back at 2008, when home prices did take a major dip, we're now well above those figures. For example, I happen to have a connection down in the Jupiter area of Florida, and I know that my friend down there bought his home in 2007, paid $800,000 for it, and suddenly at the end of 2008 it was worth, I think, like $600 or $550, something like that. And right now it's $1.3 million. So in the long run, if you just pay your mortgage and wait for the thing to turn around, you'll be fine. Hopefully we're through with the rate increases, and when they do finally start decreasing the target rate, we should see some real relief on mortgage rates, and I'd like to see them settle in around 5.0 to 5.5%. That would be good for the market and a nice stable number, and if they would maintain that number, it'd be good for the economy overall, in my opinion. But as always, I will continue to consult with people that have both bigger computers and bigger brains. So I'd like to close out this report with a couple of quotes. So we'll start with a quote from Dr. Nella Richardson, the chief economist for ADP. And she says, "Restaurants and hotels were the biggest job creators during the post-pandemic recovery. But that boost is behind us, and the return to trend in leisure and hospitality suggests that the economy as a whole will see more moderate hiring and wage growth in 2024. So that's certainly good news. And next we'll hear from Dr. Selma Hepp, and she's the chief economist with CoreLogic. And she says, home price growth maintained its upward momentum in October, which continues to reflect gains in the strong spring season and contrasts with last year's home price declines. But even with high mortgage rates, October's price gains line up with historical trends and speak to the strength of some potential buyers' purchasing power as they continue to outnumber available homes for sale. Metros that are seeing relatively stronger price gains are those with higher job growth, as well as those with an influx of higher income in migrating households. And that speaks to what I mentioned earlier. Buyer demand is still strong, and that causes me to recall the number that homes that are selling now are receiving on average 2.5 offers. Now that's down significantly from the 6 offers per home back in the summer, but still 2.5 offers every home that sells. That indicates a strong demand to me. So I hope you got good information out of this report. If you did, please like and subscribe. And I'll be watching the market and back with more news as it becomes available. So as Sebastian says, thanks for watching and have a good night.